People always want to know what I'm buying, which stocks look attractive, where the opportunities are. And those are good questions, but I've learned over 7 decades of investing that knowing what to avoid is just as important as knowing what to buy, maybe even more important. You can make a lot of money by buying the right things, but you can lose everything by buying the wrong things. One bad decision can wipe out years of good decisions. So today, I want to talk about something I don't discuss as often, the sectors I'm avoiding in 2026, and more importantly, why I'm avoiding them. This isn't about being negative or pessimistic. It's about being realistic, about understanding risk, about recognizing when the odds aren't in your favor. It's about protecting capital, which is the first rule of investing. Before I get into the specific sectors, let me tell you a story that shaped how I think about avoiding bad investments. It was back in the late 1960s and early 70s. I was running Berkshire Hathaway, and the textile business that was the core of the company was struggling. The industry was in decline. Competition from overseas was intensifying. Labor costs were high. Technology was changing. We tried everything to make it work. New equipment, better management, cost cutting. Nothing made much difference. I finally shut down the textile operations in 1985, but I should have done it years earlier. I held on too long because I didn't want to admit failure, because I felt loyalty to the employees in the community, because I kept thinking we could turn it around. But the fundamental problem was that I was fighting against powerful, irreversible forces. The textile industry in New England was dying, and no amount of effort or capital could change that. That experience taught me a crucial lesson. When you're fighting against powerful secular trends, you're probably going to lose. It doesn't matter how smart you are or how hard you work. Some industries and sectors face headwinds so strong that even great management can't overcome them. The key is recognizing those situations early and avoiding them entirely, or getting out quickly if you're already in. So let's talk about the 5 sectors I'm avoiding in 2026. These aren't necessarily bad sectors forever. Some of them might bounce back eventually. But right now, the risk reward doesn't make sense to me. The odds aren't favorable. And in investing, you don't need to swing at every pitch. You can wait for the fat pitches, the ones right in your sweet spot. The first sector I'm avoiding is commercial real estate, particularly office buildings. Now, I know real estate has been a wealth creator for many people over many years. And I'm not saying all real estate is bad, but office real estate is facing some very serious structural challenges that I think will persist for years. Let me explain what I see. The pandemic in 2020 changed how we work, probably permanently. Before the pandemic, most office workers went to an office 5 days a week. That was just how things were done. Then suddenly, everyone was working from home. Companies discovered that many jobs could be done remotely without much loss of productivity. Employees discovered they liked not commuting, liked having more flexibility, liked being able to work from anywhere. Now, several years later, we're seeing the lasting impact. Many companies have adopted hybrid work models where employees come to the office 2 or 3 days a week instead of 5. Some companies have gone fully remote. Even companies that want everyone back in the office are struggling to enforce it because employees have leverage in a tight labor market. The result is that office utilization rates are way down compared to pre-pandemic levels. What does this mean for office buildings? It means there's too much supply and not enough demand. Companies are downsizing their office footprints. When leases come up for renewal, tenants are taking less space or negotiating much lower rents. Vacancy rates in many cities are at or near record highs. And this isn't a temporary blip. This is a fundamental shift in how we work. The financial implications are severe. Office buildings were typically financed with large amounts of debt. The buildings generated rental income, which covered the debt service and provided a return to the owner. But now, with vacancies high and rents falling, many buildings aren't generating enough income to cover their debt payments. Owners are defaulting. Values are plummeting. Some office buildings in major cities have sold for 50 or 60% less than they were worth a few years ago. You might think this creates opportunity, that you could buy distressed office buildings cheap and eventually make money as things normalize. But I don't think things are going to normalize, at least not back to where they were. The shift to remote and hybrid work appears permanent for many industries. Even if the economy booms and companies are hiring, I don't think we're going back to everyone in the office 5 days a week. There are also serious questions about what happens to these buildings. Converting offices to apartments sounds good in theory, but it's often not economically feasible. Office buildings are designed differently than residential buildings. The plumbing, electrical, HVAC systems, the floor plates, the windows, everything is different. Conversion costs are enormous, often exceeding the value of the finished apartments. Some buildings will be converted, but many will just sit vacant or be demolished. I'm also worried about the knock-on effects on the financial system. Banks hold a lot of commercial real estate debt. They're going to face losses as borrowers default and collateral values decline. We've already seen some regional bank failures related partly to commercial real estate exposure. I think we'll see more stress in this area. That's another reason to avoid the sector entirely. The second sector I'm avoiding is traditional retail, particularly department stores and shopping malls. This has been a challenged sector for years, and I don't see it getting better. The forces that have been hurting traditional retail, mainly the shift to e-commerce, are only getting stronger. Think about how you shop now compared to 10 or 15 years ago. You probably buy much more online. You probably visit physical stores much less frequently. You probably comparison shop online even when you're standing in a store. This shift has been devastating for traditional retailers who built their businesses around physical stores. Department stores have been hit especially hard. These were once the anchors of shopping malls, the destinations that drew customers. But their business model is broken. They carry huge inventories across many categories. They require expensive real estate in prime locations. They have high labor costs. They can't compete on price with online retailers or on convenience with having things delivered to your door. We've seen wave after wave of department store bankruptcies. Stores that were fixtures in American shopping for generations have disappeared or shrunk dramatically. The ones that remain are struggling. Yes, some have tried to adapt by building their own e-commerce capabilities, but they're fighting Amazon and other online giants who have better technology, better logistics, and often better prices. Shopping malls are also in trouble. When the department stores close, malls lose their anchor tenants. Other retailers leave because foot traffic declines. The mall enters a death spiral. We've seen hundreds of malls close over the past decade, and more will follow. The ones that survive are often being repurposed as mixed-use developments with apartments, offices, entertainment venues, anything but traditional retail. Now, I'm not saying all retail is dead. Some categories have proven resilient. Grocery stores, because people still need to buy food and want to select fresh produce themselves. Home improvement stores, because people like to see materials and get advice for their projects. Discount retailers like dollar stores, because they serve a price-conscious customer and locate in convenient neighborhood locations. And these are doing okay. But traditional department stores and malls, I don't see how they make a comeback. The economics have fundamentally shifted against them. Even if we have a strong economy and consumer spending is healthy, I think that spending increasingly flows through e-commerce channels, not through physical stores. Why would I invest in a sector facing such powerful adverse trends? The third sector I'm avoiding is traditional media and entertainment, specifically broadcast television, cable networks, and linear content distribution. The media industry is going through massive disruption, and the old business models are breaking down. This is another area where I think the secular trends are extremely unfavorable. Let me explain what's happening. For decades, television worked a certain way. People subscribed to cable or satellite service, paid a monthly fee, and got a bundle of channels. Advertisers paid to run commercials during shows. Content creators sold their shows to networks. Everyone made money. It was a great business. But now that model is collapsing. Streaming has changed everything. People, especially younger people, don't want to pay for cable bundles full of channels they never watch. They want to pick exactly what content they want, watch it whenever they want, without commercials. They're cutting the cord in massive numbers. Cable and satellite providers are losing subscribers every quarter. Advertising revenue is declining because viewership is fragmenting across dozens of streaming platforms, traditional media. Companies are trying to build their own streaming services, but most are losing money on streaming because the competition is so intense and consumers aren't willing to pay enough to cover the costs of producing all that content. What we're seeing is value destruction across the traditional media sector. Companies that were very profitable when they controlled distribution and could bundle channels are now struggling as they compete in a fragmented streaming world where customers have all the power. The fixed costs of content production haven't changed, but the revenue per customer has fallen dramatically. I also worry about what happens with live sports, which has been the main thing keeping people subscribed to cable. Sports leagues are starting to sell streaming rights directly or to tech companies. As sports migrate to streaming, cable loses its last compelling advantage. That accelerates cord cutting and further undermines the business model. There are some winners in this transition. The big tech platforms with their scale and resources are doing well in streaming. But the traditional media companies, they're fighting a losing battle. They're spending billions to compete in streaming while their legacy businesses decline. Even if they eventually figure out streaming economics, they'll be smaller, less profitable businesses than they were in the cable era. Why would I want to own that? The fourth sector I'm avoiding is Chinese technology companies. Now, this is a complicated topic, and I want to be careful here. There are some very impressive Chinese companies with strong business models and talented management teams. In a different environment, some of these might be attractive investments. But the risks right now are just too high for me. The fundamental problem is political and regulatory risk. The Chinese government has demonstrated repeatedly over the past several years that it's willing to intervene dramatically in private businesses when it perceives threats to social stability or party control. We've seen sudden crackdowns on education companies, on gaming companies, on ride-sharing companies, on e-commerce platforms. Billions of dollars of market value have been wiped out overnight by regulatory actions. As an investor, I need to be able to predict with reasonable confidence what a business will look like in 5 or 10 years. I need to understand the rules of the game. In China right now, I can't do that. The rules can change suddenly and dramatically. A business that's thriving today can be under severe regulatory pressure tomorrow. That's not an environment where I want to deploy significant capital.
There's also the issue of corporate governance and minority shareholder rights. Many Chinese companies have opaque ownership structures. Management teams may have different incentives than outside shareholders.
If something goes wrong, your recourse as a minority investor is limited. The legal system doesn't provide the same protections you have in the United States or other developed markets. The geopolitical tensions between the United States and China add another layer of risk. There's talk of delisting Chinese companies from U.S. exchanges, of restricting American investment in certain Chinese sectors, of sanctions and counter-sanctions. I don't know how all of this plays out, but I know it adds uncertainty and risk that I'd rather avoid. I'm also concerned about the accuracy of financial information from some Chinese companies. We've seen cases of fraud and misrepresentation. The auditing standards aren't always equivalent to what we're used to in the U.S. When I'm investing, I need to trust the numbers I'm seeing. If I can't trust the numbers, I can't value the business properly. This doesn't mean China is uninvestable forever. The economy is huge and growing. There are innovative companies and enormous opportunities. But for me, right now, the risks outweigh the potential rewards. I'd rather invest in businesses where I understand the rules, where I can trust the information, where I have some visibility into regulatory and political risks. That's not China today.
The fifth and final sector I'm avoiding is speculative technology, specifically companies with no profits, no clear path to profitability, and valuations based purely on hope and hype. This includes many startups that have gone public, some cryptocurrency-related businesses, and companies in emerging technologies where commercial viability is uncertain.
Let me be clear, I'm not against technology. Some of my best investments in recent years have been in technology companies. Apple has been fantastic for Berkshire. But those are established technology companies with proven business models, massive cash flows, and reasonable valuations. That's very different from speculative technology. What I mean by speculative technology are companies that are burning cash, have minimal revenue, are years away from profitability if they ever achieve it, but are valued at billions or tens of billions of dollars because of some story about future potential. Maybe they're working on autonomous vehicles or quantum computing or some new form of artificial intelligence or space exploration or cryptocurrency applications. The problem with these investments is that you're not buying a business in any traditional sense. You're buying a story, a promise, a hope that someday this will turn into a real business. You have no idea what the economics will look like if and when the technology works. You don't know if there will be a market. You don't know what competition will emerge. You're essentially speculating. Now, some of these companies will succeed spectacularly. If you had bought Amazon or Google or Netflix early, you would have made enormous returns. But for every Amazon, there were dozens or hundreds of companies that failed completely. Most people don't realize how many dot-com companies went bankrupt in the early 2000s. Most investors in those companies lost everything. I've never been good at identifying which speculative technology bets will pay off. I don't have the expertise or the insights to evaluate cutting-edge technology that's still in development. I don't know how to value a company with no profits and uncertain prospects. And frankly, I don't want to learn. That's not where my skills are. And my strength is in evaluating established businesses with track records, understanding their competitive positions, valuing their cash flows, and buying them at reasonable prices. When I can't do that analysis because the company has no cash flows and no track record, I move on. There are plenty of other opportunities where I can use my skills effectively. I'm also worried that we're in a period where speculative technology has been overvalued. Low interest rates for many years made investors willing to pay high prices for growth stories, even without profits. Now that rates have normalized, the math looks different. The present value of distant future profits is much lower when discount rates are higher. Many speculative technology companies that raise money at high valuations are now worth far less. Some will fail entirely. I'd rather miss out on the occasional big winner than risk serious capital loss on the many losers. That's always been my approach. Don't lose money, preserve capital. Only take risks where you're being compensated appropriately. Speculative technology doesn't meet those criteria for me. Now, let me step back and talk about the common themes across these 5 sectors. I'm avoiding. If you look carefully, you'll see some patterns that can help you think about what to avoid in your own investing. First, several of these sectors are facing powerful secular headwinds. Office real estate is dealing with permanent changes in work patterns. Traditional retail is fighting the shift to e-commerce. Traditional media is dealing with the collapse of the cable bundle. These aren't cyclical issues that will reverse when the economy improves. These are structural changes that are reshaping entire industries. When you're fighting against those kinds of forces, you're probably going to lose. Second, several of these sectors involve risks that I can't quantify or control. The regulatory and political risks in Chinese technology, the uncertainty around speculative technology's path to profitability. These are risks where I don't have good tools for analysis. I don't know how to assign probabilities or estimate potential losses. When I can't quantify risk properly, I avoid it. Third, several of these sectors are trying to adapt to change, but face enormous challenges in doing so. Traditional retailers are trying to build e-commerce businesses. Media companies are trying to shift to streaming, but they're competing against companies that were born digital, that don't have legacy costs and structures, that aren't trying to manage decline in one business while building another. The incumbents are at a huge disadvantage. This gets to an important principle. Declining businesses rarely turn around. Once a business enters structural decline, it's very hard to reverse course. Management teams talk about transformation and reinvention, but more often than not, they're just managing decline. As an investor, I want to be in businesses that are growing or at least stable, not businesses that are shrinking and fighting for survival. Let me share some lessons from my own mistakes in this area, because I've learned as much from my failures as from my successes. I mentioned earlier the textile business at Berkshire. That was a case of staying too long in a declining industry. I should have gotten out sooner. I also invested in airlines multiple times over the years, usually with poor results. Airlines operate in an industry with terrible economics, high fixed costs, commodity product, intense competition, powerful unions, vulnerability to oil prices and economic cycles. I kept thinking I could find the one good airline, or that the industry had finally rationalized, but I was usually wrong. I finally learned my lesson and generally avoided airlines, though I did eventually invest again during the pandemic at what seemed like attractive prices, only to sell relatively quickly when I realized the uncertainties were greater than I initially thought. The lesson from these experiences is that some industries just have bad economics, and it doesn't matter how good the management is or how cheap the stock looks. If the industry structure is unfavorable, if the competitive dynamics are brutal, if there are no sustainable competitive advantages, you're probably not going to make good returns. It's better to avoid these industries entirely and focus on industries with favorable economics. Another important lesson is about being honest with yourself about what you understand and what you don't. I've avoided technology for most of my career because I didn't understand it well enough to predict which companies would succeed. That meant I missed some big winners, but it also meant I avoided a lot of losers. More importantly, I stuck with industries and businesses I did understand, and I've done very well in those areas. If you don't understand Chinese regulatory dynamics, don't invest in Chinese companies. If you don't understand media streaming economics, don't invest in media companies. If you don't understand how to value a speculative technology company, don't invest in speculative technology. Stay within your circle of competence. It's one of the most important principles in investing. I also want to talk about the role of pride and stubbornness in investment mistakes. Sometimes investors avoid selling declining positions because they don't want to admit they were wrong. They hold on hoping for a recovery, throwing good money after bad. I did this with the textile business. I've seen countless other investors do it with various investments. The key is being ruthlessly objective. Just because you own something doesn't mean you should continue owning it. Every day you should ask yourself, if I didn't own this today, would I buy it at the current price? If the answer is no, you should probably sell. Don't let pride or stubbornness keep you in a bad investment. This applies to the sectors I've discussed today. If you own office real estate, or traditional retail, or media companies, or Chinese technology, or speculative technology, ask yourself honestly, knowing what I know now, would I buy this today? If the answer is no, consider selling, even if it means taking a loss. It's better to take a small loss and move on than to ride something down hoping it will recover. Let me also address something important. I'm not saying you should never invest in any company in these sectors. There might be exceptions, special situations, companies that are genuinely different, but those exceptions are rare, and you need to have very strong conviction about why this particular company will succeed when the sector as a whole is struggling. For most investors, the safer approach is just to avoid troubled sectors entirely. Focus your energy and capital on sectors with favorable tailwinds, businesses with strong competitive positions, industries with good economics. There are plenty of opportunities in those areas. You don't need to venture into troubled waters. I think about investing like playing baseball with one important difference. In investing, there are no called strikes. You don't have to swing. You can wait for the perfect pitch. If a sector looks troubled, if a business seems risky, if you don't understand something, you can just pass and wait for a better opportunity. There's no penalty for not investing in something. That's a huge advantage. But most investors don't take advantage of it. They feel like they need to be fully invested all the time, like they need to have an opinion on everything, like they're missing out if they're not participating in whatever's hot. That leads to mistakes, to investments in areas they don't understand or sectors with unfavorable dynamics. I've always tried to be patient and selective. I wait for opportunities that fit my criteria. Businesses I understand with sustainable competitive advantages, run by capable and honest management, available at reasonable prices. When I find those, I invest. When I don't, I wait. And I definitely avoid sectors where the odds are stacked against me. As I think about 2026 and beyond, I'm comfortable avoiding these 5 sectors. I don't need to own office real estate or department stores or cable networks or Chinese technology stocks or speculative technology companies. There are plenty of other places to invest where the odds are better, where I understand the businesses, where the trends are favorable rather than adverse. The investors who will do well over the next decade are the ones who recognize these challenge sectors and avoid them while focusing their capital on businesses with durable competitive advantages operating in favorable industries. It's not exciting. It doesn't make for good cocktail party conversation, but it works. It protects capital, which is the first priority, and it allows you to compound your wealth over time in businesses with good long-term prospects. So that's what I'm avoiding in 2026. Office real estate, traditional retail, traditional media, Chinese technology, and speculative technology. These sectors face serious challenges that I don't think will be resolved quickly or easily. The risks are high, the odds are unfavorable, and there are better opportunities elsewhere. I'd rather focus my time and capital on those better opportunities than try to catch a falling knife in a troubled sector. That's always been my approach, and it served me well for over 70 years. I see no reason to change it now. Let me dig deeper into why avoiding mistakes is so crucial to long-term investment success. A lot of people focus on finding winners, on picking stocks that will double or triple. That's exciting. And yes, it can make you money. But avoiding big losers is actually more important to your long-term returns than finding big winners. Here's the math that explains this. If you invest $100,000 and it goes down 50%, you've lost $50,000. Now you have $50,000 left. To get back to where you started, you need a 100% return. You need to double your money just to break even. That's a much harder task than avoiding the 50% loss in the first place. This is why I'm so focused on not losing money. It's not just a conservative philosophy, it's mathematical reality. Big losses are devastating to your long-term compounding. If you can avoid major mistakes, even if you don't hit many home runs, you'll do very well over time through steady compounding of decent returns. The sectors I've talked about today all have the potential to inflict serious losses. Office real estate values could decline another 30, 40, 50% from current levels as the full impact of remote work plays out. Traditional retailers could go bankrupt as e-commerce continues taking share. Media companies could see their legacy businesses shrink to a fraction of their former size. Chinese technology stocks could be halved overnight by regulatory actions. Speculative technology companies could go to zero when they run out of funding and never achieve profitability. These aren't theoretical risks. These are real possibilities. And in some cases, they're already happening. By avoiding these sectors entirely, I'm protecting myself from these potential losses. I'm keeping my capital safe and available for better opportunities. That's good risk management. Now, some people might say I'm being too conservative, that I'm missing opportunities, that some of these sectors will bounce back. And maybe they're right. Maybe office real estate will find new uses and values will recover. Maybe traditional retailers will successfully transform themselves. Maybe Chinese technology companies will thrive despite regulatory uncertainties. Maybe speculative technology bets will pay off huge. But here's what I know. I don't need those sectors to succeed. I have plenty of other opportunities where the risks are lower and the odds are better. I can make excellent returns investing in banks, in energy companies, in consumer brands, in industrial businesses, in established technology companies. Why would I take on the extra risk in troubled sectors when I don't need to? This gets to another important principle. You only have to get rich once. A lot of investors take excessive risks because they're trying to get rich quick. They swing for the fences on every investment. They chase the hottest trends. They put money into speculative situations, hoping to hit it big. Sometimes that works, but more often it leads to losses and disappointment. My approach has always been different. I focus on steady compounding over long periods. I protect my capital. I take risks where I'm being compensated appropriately and where I understand what I'm doing, and I'm patient. This approach might not generate the highest returns in any given year, but over decades it works extremely well. And importantly, it keeps working even when markets get difficult. Let me tell you about another factor in my decision to avoid these sectors. The quality of management teams you typically find in them. When an industry is in structural decline or facing severe challenges, it tends to attract or retain a certain type of management. Often, these are managers who are trying to preserve their positions in the status quo rather than facing reality and making tough decisions. Think about department store executives who keep insisting that physical retail will come back, who keep investing in stores rather than admitting the business model is broken. Or media executives who can't accept that the cable bundle is dead and keep trying to prop it up. Or real estate developers who can't acknowledge that demand for office space has permanently declined. These managers are in denial, and denial is very expensive for shareholders. The best managers, the ones who are honest and forward-thinking, tend to avoid dying industries. They go where the opportunities are, where they can build and create rather than manage decline. This means that by the time an industry enters serious trouble, the quality of management across the sector tends to be poor. That's another reason to avoid these sectors. I also want to talk about the role of debt in making some of these sectors particularly dangerous. Office, real estate is heavily leveraged. Many retail companies carry substantial debt. Media companies took on debt to build streaming services and compete with tech giants. When businesses are struggling and highly leveraged, the risks multiply. If a business is having trouble but has a clean balance sheet, it has options. Management can cut costs, refocus the business, wait for conditions to improve. But if the business is highly leveraged, it doesn't have that flexibility. The debt service requirements keep coming. If cash flow falls short, the company faces default, bankruptcy, value destruction for equity holders. Debt turns problems into crises. This is why I always pay close attention to balance sheets. I prefer businesses with little or no debt, or at least manageable debt levels relative to their cash flows. When I see a troubled sector where companies are also highly leveraged, that's a huge red flag. The combination of industry challenges and financial leverage is often lethal for shareholders. Let me share some wisdom about market cycles and how they relate to sector selection. Every sector goes through cycles. Sometimes the sector is in favor, capital flows in, valuations are high, optimism abounds. Other times, a sector is out of favor, capital flows out, valuations are low, pessimism dominates. These cycles create opportunities for contrarian investors who buy when sectors are hated and sell when they're loved. But here's the crucial distinction. You need to distinguish between cyclical downturns and structural decline. A cyclical downturn is temporary. Demand falls due to recession or some other factor, but eventually the economy recovers, demand comes back, and the business returns to health. A structural decline is permanent. The fundamental drivers of the business have changed in ways that can't be reversed. Energy companies went through a cyclical downturn when oil prices crashed. That created opportunity because eventually prices recovered and the companies returned to profitability. That's very different from what's happening in office real estate or traditional retail. Those aren't cyclical downturns, those are structural declines. The underlying dynamics have changed permanently. Waiting for a recovery is futile because there won't be a recovery to pre-pandemic levels. When I'm evaluating whether to avoid a sector, I'm asking, is this temporary or permanent? Is this cyclical or structural? If it's temporary and cyclical, it might be a buying opportunity. If it's permanent and structural, it's something to avoid. The sectors I've discussed today all have structural issues, not just cyclical ones. I want to address something else that's important, the role of innovation in these troubled sectors. And some people argue that innovation will solve the problems I've described. Maybe new technology will make office spaces so attractive that people will want to come back. Maybe new retail concepts will bring shoppers back to physical stores. Maybe new business models will save traditional media. I'm skeptical. Innovation is wonderful, and it solves many problems. But innovation can also be the cause of disruption that destroys existing businesses. E-commerce is innovation that destroyed traditional retail. Streaming is innovation that destroyed cable television. Remote work technologies are innovation that's undermining office real estate. In these cases, innovation isn't the solution, it's the problem. For innovation to save these sectors, you'd need innovation that fundamentally changes the economics or that creates new sources of value. I don't see that happening. The innovations I see tend to reinforce the existing trends rather than reverse them. Better remote work tools make it easier to work from home, not harder. Better streaming technology makes cord cutting easier, not harder. Better e-commerce platforms make online shopping more attractive, not less. Now, let me talk about what I think about timing. When should you avoid a sector? Should you wait until the problems are obvious to everyone, or should you try to anticipate them early? This is a tricky question, and I don't have a perfect answer. Uh, on one hand, if you wait until everyone recognizes the problems, you might have already suffered losses. If you owned office real estate in 2019, before the pandemic, your investment looked fine. Then suddenly the world changed and you were facing steep losses. If you'd anticipated the vulnerability of office real estate to changes in work patterns, you might have avoided it earlier. On the other hand, if you try to anticipate problems too early, you might avoid sectors that still have years of good performance ahead. You might miss out on profits while waiting for problems that take longer to materialize than you expected. This is particularly true with structural declines, which often play out over many years rather than happening suddenly. My approach is to look for clear evidence of structural challenges, not just theoretical possibilities. When I see declining industry metrics that persist across multiple quarters and years, when I see companies struggling despite strong management and good execution, when I see new competitors or technologies that clearly have better economics, that's when I know to avoid or exit a sector. For the sectors I've discussed today, the evidence is clear. Office vacancy rates have been elevated for years now since the pandemic. Retail sales continue shifting online quarter after quarter. Cable subscription losses are accelerating, not slowing. The Chinese regulatory environment for technology has become demonstrably more unpredictable. Speculative technology companies are running out of funding and failing. These aren't theoretical future problems. These are current realities. Let me also talk about the psychological challenges of avoiding sectors. It's hard to sit on the sidelines when everyone else is making money in a hot sector. You feel like you're missing out. You see others getting rich while you're not participating. The fear of missing out is a powerful emotion, and it leads many investors to make mistakes. I've never cared much about keeping up with what everyone else is doing. I don't invest in something just because it's popular or because others are making money in it. I invest based on my own analysis of value and risk. If that means missing out on some gains in sectors I don't understand or don't like, so be it. I'd rather miss out on some winners than participate in losers. This mindset requires confidence in your own analysis and the discipline to stick with it, even when you're out of step with the crowd. It's not easy, but it's essential for long-term success. The crowd is often wrong, especially at extremes. When everyone loves a sector and valuations are sky high, that's usually a time to be cautious, not enthusiastic. When everyone hates a sector and valuations are depressed, that's often when opportunity emerges, though you still need to distinguish between cyclical downturns and structural declines. I want to close by talking about how this philosophy of avoiding troubled sectors fits into a broader investment approach. Avoiding mistakes is necessary but not sufficient for success. You also need to identify good opportunities and invest in them with appropriate position sizes. You need to be patient and let your investments compound over time. You need to maintain emotional discipline through market volatility. You need to keep learning and adapting as the world changes. But everything starts with capital preservation. If you protect your capital by avoiding big mistakes, you'll have the resources and the patience to invest in good opportunities when they arise. If you blow up your capital with bad investments in troubled sectors, you won't have that luxury. You'll be starting over, trying to recover from losses, unable to take advantage of opportunities. This is why I spend as much time thinking about what to avoid as I spend thinking about what to buy. Both are essential. And right now, in 2026, the 5 sectors I've discussed today are at the top of my avoid list. The risks are too high, the odds are too unfavorable, and there are too many better alternatives. I'll happily sit on the sidelines in these areas and focus my energy and capital elsewhere. That's been my approach for 7 decades, and I'm not changing it now.